Hey friends, hope you guys are having an amazing start of the year, and in today's video I'm going to go through all the PDArray matrix, what it is, why it is so important for us to learn it, and when do we use it and how do we use it. Mastering PDArray matrix will help you tremendously in determining your daily bias, helping you to understand the institutional order flow and the overall direction of the market.
What is PDArray matrix? P stands for premium and D stands for discount. Array just means a list of tools, a list of things. So in short, PDArray is just the difference between premium and discount inside a dealing range. And the dealing range is the new trading range formed after buy side or sell side is taken. So imagine if you are a business owner. Logically, you want to sell your goods or services as high as possible, and you want to make it so expensive that you want to make so much profit, and also buying the materials to make these goods and services as cheap as possible so that you can keep the cost low. Similarly, in the market, you want to buy at discount and sell at premium. As you can see here, anything above the 50% will be in premium, and anything below the 50% will be in discount. This is what the smart money are doing. They are pairing buy stop orders. Let's say for those traders who are going long thinking that the price is going higher, that's where the smart money will sell to pair those orders and to drive the price lower. So for discount, smart money are accumulating all the positions in a cheaper price, and that's where the retail traders were panic selling because they think the price would go even lower. But the reverse is true. They will liquidate their positions when the price reaches a premium level. That's where smart money will sell. And we can identify premium and discount by finding the highest long-term swing high and the lowest long-term swing low. For swing high, we need to see the lower high to the left of it and the lower high to the right of it. And when the fourth candle forms, it confirms the swing high. For the swing low, we need to see a higher low to the left of it and a higher low to the right of it. As you can see in this diagram, when a fourth candle forms, the swing low is confirmed. Usually we only need 3 candles to see swing high or swing low. For confirmation, we just need the fourth candle to form. By looking at this chart example, can you quickly identify the premium zone and the discount zone? We're not going into the PD arrays yet. Just identify the dealing range, look for the swing high, swing lows, and also identify the premium range and the discount range. Pause the video if you need to before I mark up my chart.
I need some more coffee. Let's get back to work.
Before we continue, I also want to add in the element of time. We want to be using time and price together. So for this example, we want to look at 20 days, 40 days, or even 60 days look back to identify the range. Which is why I have drawn these vertical lines right over here, here, and here. If you couldn't find the dealing range between 20 days, look even further back for 40 days or even 60 days. So you want to identify those swing highs and swing lows formed within this period of time. We are not going into years and years and years of data. We're not going to look back so far away. We're just going to look at the very recent price action within a 2-month period. So this is our premium and discount zone. As you can see, this is our swing high and this is our swing low. Similarly, this is our swing high and this is our swing low. Why is it so important to understand PDArray matrix? Because algorithm always seek PDArrays and it is always reaching for these price points and levels. Since price under the algorithm will always draw to liquidity, rebalancing, and creating imbalances. But you need to take note that not all PDArrays will be present in your price action. Only use what is available, and you will understand later when I show you more examples. Also, by mastering PDArray matrix will help you tremendously with your daily bias, overall direction of the market, and understand institutional order flow. So let's identify some of the arrays that we use in our price action. So for our premium discount array matrix, these are the list of the arrays that we use. We have our all high, rejection blocks, bearish order block, fair value gap, liquidity void, bearish breaker, mitigation block. This is for price to move from premium to discount. And these are in sequence of importance. As I mentioned earlier, this is from premium to discount, and we listed this like arrays. These are the tools that we use in order of significance. That's when price will draw from premium to discount. So as the price is moving higher and higher, and we reaches a higher time frame key level, and we have a market structure shift, the price keep on going lower and draw on liquidity to our discount level, which is right over here. This is our market maker sell order. Sorry, market maker sell model. So let's look at our arrays. We have our O high and O lows. I won't be going so much in details about their definition, but I'll just generally go through what are they. If you need some more in-depth understanding, go and reference our ICT channel. He go much more in-depth. For the purpose of this video, I'm just going to quickly go through what are they, and we're going to quickly look at our examples. This is our O low. So this is our sell side liquidity. This is our internal liquidity. That's when price took out the liquidity and start moving higher. We have our long-term high. This is our buy side liquidity. This is our external liquidity. Price tap into the liquidity, liquidate all the buyers who are trying to buy at this price point, and that's when the market maker or the smart money, they will liquidate. That's when they sell and bring the price lower. So let's move on to the next PDArray. We have rejection block. For bullish rejection block, price low has formed with a long wick of the candlestick and price reaches down the body of the candle, which is here. Price reaches down the body of the candle to run sell side liquidity out before price rally higher. So this is our bullish rejection block. For our bearish rejection block, price high has formed with a long wick of the candlestick and the price reaches up above the body of the candle to run buy side liquidity out before the price drop even lower and break in our structure and our market structure shift. One of the key things that you have to remember for rejection block is that they didn't run out the buy side liquidity right over here and the sell side liquidity right over here. For our bullish order block, this is our last down close candles before price rally higher. This is our last down close candles. They can be consecutive candles. For our bearish order blocks, we have our up close candles before our price drop even lower. They can be consecutive candles. One simple trick to find high probability order blocks is to look for fair value gap after the price move. Fair value gap gives you the confirmation that this is a valid order block and the price is likely to respect the order blocks. So once the price rally and break above all the down close candles, we have our fair value gap forming. This gives a confirmation that this is a high probability bullish order block and the price will respect perfectly and move even higher once the price tap into the bullish order block. For bearish order block, it's the same as well. Once we have our bearish order block form, once the price left this area and the price came back to these fair value gaps, these fair value gaps forming give a confirmation that our bearish order block is high probability and the price, whenever price come into these areas, the price will respect these areas and go even lower after it tap into the bearish order block. Fair value gap is the foundation of our 2022 YouTube mentorship, so I don't think I need to explain much more. It is very obvious. This is our bullish fair value gap. This is our bearish fair value gap after our market structure shift, So let's move on. For liquidity void, we have a very large movement of price, and the reasoning is behind is price has been repriced very aggressively and price only offer buy side liquidity. So for bullish liquidity void, this is the void of sell side liquidity, inefficient in sell side. That's why with high great deal of probability that the price will draw back into all this liquidity void and even eventually filling it up fully before even going higher. So let's say for bearish liquidity void, price only offers sell side only. There is very little buying took place here, which is why all this aggressive repricing, price will eventually come and fill this inefficiency before going even lower. So for our breakers, we need to see a liquidity taken before a market structure break. So for bullish breaker, once we took out our sell side liquidity right over here, we have a very aggressive price displacement breaking our structure, and the last up close candles right over here, this is our bullish breaker. As you can see, the price respected perfectly before going even higher. For bearish breaker, it's very similar. We have our buy side liquidity taken. Once we have liquidity taken, we want to see a market structure shift with displacement, and the last down close candle will be our bearish breaker. Once the price retraced back to the breaker and respected it, and the price continue going even lower. For breakers, the reason behind it is because the buyer who bought here, they want to reduce or mitigate their loss, which is why this is our good point for consider to sell and look for our sell setups. Mitigation block, it's very similar concepts to breaker block, but the slight difference is that it creates a failure swing. It doesn't break our liquidity. It doesn't take out our liquidity. And once the price fails to take out the liquidity and we have a market structure shift, the very last up close candle will be our bullish mitigation block. For bearish scenario, we have our market structure shift, and the last down close candle will be our bearish mitigation block. So this is the only difference between mitigation block and breaker block. It's just that they didn't take out the liquidity, but we have a market structure shift and with displacement. Once the price reach a key level from the higher time frame, potentially a resistance level, and when the price failed to make that swing high and break the market structure, giving us the confirmation that with energetic displacement and of course with some bearish context behind it, the market structure shift seen here with a break below all low, it's where the smart money is showing its hand to you that it wants to go lower, yet behind the marketplace driving price lower. This is a very clear indication that the market wants to break down. Look for the last close candle at this low. So when the price return back to the mitigation block right over here, so that's where the buyers, they want to mitigate the loss, because when the price broke lower, broke the structure, it is referred as buyer remorse. The buyer who bought at this previous low, they're given the opportunity to cut their losses. So this is our sell setup. This is our short setup, targeting our drawn liquidity to the lower prices or other PDArrays lower that we have not tapped into yet. Let's say an imbalance that needs to be rebalanced or a bullish order block on the higher time frame. So you should notice by now that we always reference to the higher time frame levels for our target. In short, this is our classic break and retest, classic support, broken, turn, resistant. So just keep it very simple. You don't need to really complicate the concept. But of course, try to understand the key concept behind the reasoning behind it. So moving on, let's go and combine all the concepts that we learned, and so let's look at how we can apply this to our real market. After we identify the premium and discount zones, now we want to highlight all the PDArrays in the order of the significance. First, we have our all high, which is the swing high of this point, and this is our rejection block. As you can see, the price form a wick, so the price can potentially come and retest the rejection block or take out our all high before going down. So this is in a bearish market, so the price has to break through a lot of resistance in order to reach this point. Ideally, we don't really want the price to come back to retest all these PDArrays, because the less it does it, it's more evidence that the market is very weak. As you can see, we have our rejection block. This is our midpoint of our bearish order block. This is the midpoint of bearish order block. This is all the up close candles, our consecutive candle. This form as a whole order block as a whole. The main threshold of the order block. We also have our fair value gap former right over here. As you can see, the price tap into the fair value gap before going even lower. Once it retraces back to the fair value gap, it dropped. That means that the price is very weak. It doesn't have the strength to come and retest our bearish order block or rejection block or even our all high. So which is very good. Smart money is showing their hands that they really want to reprice back to the discount level right over here. Once the price took out our buy side liquidity right over here, we have our market structure shift, and the last down close candle will be our bearish breaker. As you can see, we don't really have our liquidity void and our mitigation block, which is why I mentioned earlier, you shouldn't look for every PDArrays. Only use what is provided and what is available in the market. Of course, when you go down to the lower time frame, you might find the liquidity void in this smaller time frame, and you might also find the mitigation block on the lower time frame. So on this daily time frame, we were only given these PDArrays, so we only want to work with these PDArrays. So as you can see, the price repriced back to the discount level, discount zone. This is our swing low, and So potentially, once we arrive at our discount level, we want to potentially see if price want to retrace back to our premium level before we go for short setups. So obviously, when price retrace, this is our another order block, this is our fair value gap as well. So as you can see, the moment price retrace back to our premium level, the price tap into our bearish order block and our fair value gap, and the price respected it perfectly. That's when we keep on going down, targeting this low liquidity, which is our sell side liquidity, and eventually we make a new lower low. So once we have a new lower low and we have a high form, we can set up a new dealing range. We can identify our new dealing range. Similarly, this is our fair value gap right over here, and these up close candles will be our bearish order block. As you can see, price almost tap into our, actually it did tap into our bearish order block. So I will show you guys more in details in the next slide. But before that, let's look at our PDArray matrix from the perspective of from discount to premium. We start with low, rejection blocks, bullish order block, fair value gap, liquidity void, bullish breaker, and bullish mitigation block. So as mentioned earlier, we have our fair value gap. Once the price drop down to our discount level and we have our confirmation swing low has formed, and the price is showing sign that it wants to go higher to rebalance this inefficiency right over here, and the price also attract to our bearish order block right over here. This is our consecutive up close candle. This is our bearish order block. So price want to retest all these levels, and this is our draw on liquidity. This is our also bullish order block right over here. So as you can see, price tap into our bullish order block and went even higher to our premium. So price will be always drawing from premium to discount, and from discount to premium, and from premium to discount. So this can be very helpful to help you identify the daily bias. Let's say the price is trading around here, you can anticipate the price to go higher to rebalance this fair value gap. Once we have our confirmation, you might buy here and you lost, and that's fine. The next 2 days is bullish, so you can make your money back in these 2 bullish days, even though you lost your money on this bearish day. We want to look at premium and discount using these PDArray matrix. We have our high or low, our rejection blocks, order blocks, fair value gap, liquidity void, bearish breaker, mitigation blocks. The price will always be drawing from premium. Once you reach a premium, we'll be drawing to discount. Once you are in discount, we'll be wanting to draw into premium level again. So that's the only key thing you need to remember, that price always run on liquidity, trading imbalances, and rebalancing price. I also make this PDF available for you to download for your studies, and make sure you check the link in the description. I also want to emphasize that make sure you go and learn from Michael directly, check out his channel, because there are so many details that I missed I didn't cover in this video. By learning PDArray matrix will be the key to unlock the understanding to daily bias, institutional order flow, and the overall direction of the markets.
This is another episode of Learning ICT Concept together with me, and hopefully by making all these videos, it will help me to retain all the information from me, and also at the same time to help you guys simplify some of the concepts and shorten your learning curve. If you find this video helpful, check out this video where I talk about daily bias, and you can apply PDArray matrix so that you can understand daily bias and institutional order flow much easier. Of course, you need to refer back to Michael's channel because he go into everything much more in depth. I'm just here to help you guys to simplify some of the ideas and some of the concepts. You are closer than you think, and I'll see you guys in the next video.